Thank you, Charlie, for coming. How do you pronounce your last name?
Bilello.
Bilello. Thank you, Charlie Bilello from Pension Partners. You cover everything: Fed, economy, equity markets, bonds, and they are all acting in different, weird, non-traditional ways nowadays.
Sure.
But let's start with Fed, because today is the anniversary, right? Anniversary of Bernanke's introducing us the actually the tapering strategy. I shouldn't say exit strategy, because exit strategy has been being talked about like for the last 3 years.
Right, sure.
So looking back, what has changed? Do you think his actions impacted the financial markets, economy in a positive way? What is Pension Partners' take in terms of Bernanke's decision since it started
Right.
last year, today?
So it's interesting. Last May, we had, as you said, Bernanke introduced the concept of tapering. And initially, you had this massive sell-off in stocks, emerging markets, U.S. stocks, and bonds of all durations. So that persisted through May and June of that year, and it was a sharp, sharp sell-off. Then the market began to digest it. Now, what's interesting is once they actually started the tapering this January, we're seeing the opposite reaction. We're seeing bonds rally and yields fall throughout the tapering so far. So it looks like the market front-run the Fed a little bit in selling all asset classes on the rumor of tapering, and now they're kind of buying the news, at least in bonds. So it's interesting that yields are falling despite the Fed pulling back. I think that's the most interesting thing here.
Why do you think it's happening, that these things are happening with the yields?
Sure. I mean, it's just the global deflationary pressures are simply too great. And the Fed's been keeping interest rates at 0% for over 5 years. That's beyond unprecedented. It's never happened in history, even that the Fed would keep rates at a low level for 1 year. Now we're at 5+ years and multiple rounds of QE. And through all of this, they're talking about they want to generate inflation expectations. They want to generate wage growth, and they just haven't been able to do it. So you have these global deflationary pressures, such as demographic changes, technological changes, that are simply too great to overcome, no matter how much stimulus they put out there. And I think the Fed realizes that, and that's why they're starting to pull back, because they need to create a sense of urgency for people to stimulate demand in the economy. And as long as there's endless QE and low rates, there's no urgency for people to start doing anything.
Yesterday, the FOMC minutes were announced. FOMC minutes from April 29-30 meeting, right?
Yep.
And Charlie, I did not see anything other than more dovish tone, but they did talk about the instruments, even the overnight repos, but they never said the timeline or how.
Right.
I think the only one clear thing is we're going to see a lot of talks about the exit strategy within the next meetings, many meetings, future meetings.
Right.
But what was your feeling about yesterday's meeting? Did you feel like they are unsure of how to get out of it and how to introduce the new rate hike? Or do you think there are some divisions, like they are divided in themselves? Is that why? Or what is your comments on it?
Yeah, well, there was nothing really new that we saw in the minutes, more of the same. And since the last Fed minutes, where the market kind of reacted quickly in a negative fashion, Yellen's done nothing but back away, setting a timetable. She doesn't want to set any timetable. She's been clear it's going to be data dependent, and that protects them, because if there is a slowdown in the economy, if the markets start reacting negatively, they want to be able to either slow down in tapering or keep rates longer for a longer period, and they don't want to be boxed into having said we're going to exit and this is when we're going to exit. So it's very much a strategy on their part, and what the Fed has shown in the past few years, if we look at QE1 and QE2, and when they pulled away, as soon as the market reacted, in 2010 there was a 17% correction. In 2011 there was a 21% correction in the S&P, and what did the Fed do after both of those corrections? Well, they came right back in with another round of QE. So I think they're creating, by tapering and talking like this, they're creating room to launch an additional round if there's another sell-off or if there's slowdown in the economy.
That's true. They do take the financial market sensitivity and the volatility into consideration. Talking about S&P 500, it's fast approaching the 95, 96 record. Like you said here, you told me for the consecutive days about the 200-day moving average. I mean, what does this mean for the markets? S&P 500's erratic. Can I say erratic? A little
Well,
crazy move?
it's an unbelievably smooth, steady move over the past 2 years. So we've seen it's really unprecedented, except for 95, 96.
Unprecedented. That's what I was looking for.
Correct. Yeah. So what it means for market participants is it's built up this level of complacency, and you see this in the VIX. The VIX is at 11 now, and you see it in sentiment polls. The bulls outnumber the bears in investors' intelligence by 3-1. So everyone's very bullish and complacent. And rightfully so, because the markets have done nothing but go up. But if we look at it right here and now, it's a level of risk, because it's gone on for so long without a correction, and the longer it goes, the higher the probability we're going to see something, and see something soon, especially with this change in Fed policy. So I think investors and market participants need to be aware that there is a change going on in the market, and they shouldn't be as complacent as they are.
I think you kind of answered, but with the S&P at new highs, small caps, Russell 2000, that is down over 10% from their March highs. All the internet and small caps have been underperforming, right? Whenever there was a volatility from March highs, and high growth momentum names have been crushed. We've seen that. Have we seen this divergence before, and what does it mean for markets going forward?
Yeah, it's very interesting. It's really a selective correction going on out there. And if you look at March and April, the Russell 2000, which is the small cap index, was down in both of those months. And the S&P was up in both of those months. That's never happened in the history of markets. Now, we have seen divergences where small caps are down and large caps can advance, but not usually persist for that long. So what it's telling us is that market participants are rotating. They're getting out of higher growth small cap names, going into larger cap defensive names. And we're seeing this across sectors, across industry groups, and you're seeing high momentum areas such as biotechnology stocks and social media stocks get hit very hard over the last few months. So it's really a selective correction. What does that tend to precede? It tends to precede a larger correction in all equities. So we'll see what happens. I mean, so far the S&P's been very resilient because everyone's complacent, saying it hasn't gone down, it's going to continue. But if this pressure continues, this rotation, it's definitely a negative sign. So we'll see.
Thank you so much. Well, I want to ask you the U.S. consumer, the signs, and also Fed's comment on the construction and also in the housing sector, actually, because they talked about the bottlenecks. But our time is up. You'll have to come again, and then we'll talk about those topics as well. Thank you for coming.